Hi, this is a brief introduction to what accounting is. Accounting is defined as the process of recording, summarizing, analyzing, interpreting, and reporting the financial information of an economic entity. So, what does this technical definition here means? It means an entity needs to record all of its financial transactions. Rather than showing all of its transactions, which would be too voluminous, the entity needs to summarize it. So for example, rather than showing all the sales transactions in a particular year, the entity should summarize the total sales figure for the year, which will be more meaningful for the users than to show the hundreds and thousands of transactions. Next, to analyze and interpret the financial information means, for example, the entity may notice that sales have increased by 5%. Is this good? More importantly, what contributes to the increase? Finally, this financial information needs to be reported to the various users. I'll explain this in greater details later. As you move on with accounting, you will get to see how financial information is reported, be it for internal management or for external reporting. Now, moving on to the flow of accounting. This comprises of 5 steps. First, the entity needs to collate its source document, which is a record that a transaction has occurred. Source document comes in many forms. The more common ones are the invoices, receipts, bank statements, or payroll data. Sometimes, for non-routine transactions, the source document could be from the entity's meeting transcript, letters sent to the entity, or even in the news, though that would mean something big has happened for it to appear in the news. Next, after collating these source documents, the entity needs to prepare journal entries to record these transactions. Journal entries specify which account need to increase, which account need to decrease, and by how much do they need to increase or decrease. Then, all the journal entries will be entered into the ledger accounts. You can see the detailed movement within each ledger accounts. So for example, the cash account will show you cash movement within the period, each transaction that caused the cash balance to change, whether it is an increase or a decrease, and by how much did it increase or decrease. After all ledger accounts are prepared, all the account balances will be presented in the trial balance. The trial balance also works by checking for arithmetic errors, which will be explained in the trial balance video. Finally, the last step is the preparation of financial statements based on each account balance. The 4 major financial statements are the income statement, balance sheet, statement of changes in equity, and cash flow statement. We will go through these financial statements in details in their respective videos. Accounting is broadly classified into 2 categories: financial accounting and cost management accounting. Both are accounting, which follows the definition I presented earlier. But what distinguishes them then? Firstly, financial accounting is for external reporting. Cost management accounting is for internal reporting. This means cost and management accounting involves confidential data about a company, which is not supposed to be reported externally. Secondly, financial accounting is more formal than cost management accounting. When publishing the accounts externally, the accounts must be prepared in accordance with the FRS, Financial Reporting Standards. For internal reporting, the information can be presented in any format, as long as the users can understand it. Thirdly, the purpose of financial accounting is to inform the public about the economic status of the company. On the other hand, cost management accounting helps the manager monitor the company's performance and make decisions pertaining to the company. So some of the decisions may include whether to drop a product line, to start selling a new product, how to minimize costs, how to improve sales, or even how to make the best use of excess funds and others. Finally, financial accounting focuses on past data. You'll notice that financial statements are published after year end, and it showcases the performance of the company over the past year. On the other hand, cost management accounting focuses on past, present, and future data. Data of all time frame is useful to some extent in helping managers make decisions for the company.